stop what you are doing right now, because there is a date that is quietly but relentlessly appearing in every single major financial model, every single debt projection, and every single economic forecast across the globe. That date is 2026, and if you don't understand why, you're about to be blindsided by the single biggest financial event of the decade. This isn't a prediction of a slow, gradual decline. This is a hard mathematical deadline, a fiscal cliff that the world's largest economy is hurtling towards. The numbers are staggering, almost too big to comprehend, but you must. In 2020, the interest payments on the US national debt were around $345 billion. A huge number, but manageable. Fast forward just a few years, and by 2026, that annual interest payment is projected to top $1 trillion. Let that sink in. $1,000 billion. That is more than the entire defense budget. It is more than the budget for Medicare. It is the fastest growing line item in the entire federal budget, and it is money that is simply being burned, generating zero return for the American people. It is the cost of simply existing under a mountain of debt. But the interest payment is just the symptom. The disease is the debt wall of 2026. This is the moment when a massive, unprecedented amount of short-term debt issued during the low-interest rate era comes due and must be refinanced at today's or tomorrow's much higher rates. It's a refinancing crisis disguised as a long-term debt problem, and it's why every debt model, from the Congressional Budget Office to the most conservative Wall Street firms, has a giant flashing red warning sign next to the year 2026. This is the story of how the US government painted itself into a corner, how the Federal Reserve became an unwitting accomplice, and why 2026 is the year your personal finances, your investments, and your future will be irrevocably changed. Stay with me, because what I'm about to show you is the blueprint for the next financial crisis, and more importantly, how you can prepare for it. This isn't just dry economics, this is about the value of your savings, the stability of your job, and the future of your investments. The clock is ticking, and the time for denial is over. The term debt wall sounds dramatic, and it is. Imagine a dam holding back a massive reservoir. That dam is the US Treasury's ability to roll over its debt. The water is the $38, $5 trillion national debt. And the cracks are appearing right now. What exactly is happening in 2026? It's a confluence of factors, but the most critical is the maturity schedule of the debt. When interest rates were near zero, the Treasury issued a huge volume of short-term debt, 2-year, 3-year, 5-year notes. This was cheap money. But now, that debt is maturing, and it has to be reissued. The problem is that the interest rate environment has fundamentally changed. The Federal Reserve, in its fight against inflation, has raised the Fed funds rate to levels not seen in decades. When the Treasury refinances that old cheap debt, it has to pay the new expensive interest rate. This is the mechanism that is driving the $1 trillion interest payment. It's a vicious feedback loop. More debt requires more interest, which adds to the deficit, which requires more debt, and so on. According to analysts, approximately 70% to 80% of all financial market transactions today involve debt refinancing rather than new capital raising. This is a market obsessed with survival, not growth. It's a market where the primary activity is simply pushing the problem further down the road. But in 2026, the road runs out. The market is already signaling this stress. The bond vigilantes, the investors who punish profligate governments by demanding higher yields, are waking up. They are looking at the CBO's projections, which show the US debt to GDP ratio on a path to rise indefinitely, soon crossing the 100% threshold. This is the point of no return, where the debt becomes so large that the only way out is either massive tax hikes, severe spending cuts, or, most likely, inflation. Before we dive into the 3 specific models that all point to 2026, please take a second to like this video, subscribe to Mac Invests, and hit the notification bell. It helps us cut through the noise and get this critical information out to more people who need to hear it. The title of this video is not hyperbole. 2026 truly appears in every debt model. Why? Because 3 distinct independent models converge on this year as the inflection point. Model 1, the CBO's fiscal forecast. The Congressional Budget Office is the non-partisan scorekeeper for the U.S. government. Their long-term budget outlook is grim. They project that the U.S. debt held by the public will reach 100% of GDP in the next few years, and the deficit will widen to 7% of GDP by 2026. This isn't just a number, it's a psychological barrier. Historically, when a developed nation crosses the 100% debt to GDP mark, it signals a loss of fiscal control and often leads to a permanent downgrade in credit rating, which, again, drives up the cost of borrowing. The CBO model is a purely mechanical projection based on current law, and it screams 2026. The grim reality is that this 7% deficit projection for 2026 is not a worst-case scenario. It is the baseline. It assumes no new major spending programs and no economic downturn. The CBO itself has warned that this path is unsustainable, leading to a permanently higher interest rate environment that will stifle private investment and economic growth for decades. The debt is not just a burden. It is a structural impediment to future prosperity. Model 2, the refinancing schedule model. This is the most immediate and terrifying model. It tracks the maturity dates of all outstanding Treasury securities. The peak of the refinancing wave, the moment the most short-term debt needs to be rolled over at high rates, is centered squarely on 2026. This model is less about economic growth and more about simple arithmetic. The sheer volume of debt maturing in that year creates a supply shock in the bond market. Who is going to buy all that debt, and at what price? The answer is only at a much higher interest rate, which is why the interest payment projection is so high. To put the volume in perspective, the U.S. national debt has already surged past $38, $5 trillion years ahead of projections. The Treasury must issue an unprecedented amount of new paper just to stay afloat, a process that will inevitably drive down bond prices and push yields even higher, further accelerating the interest payment spiral. This is a debt rollover crisis of historic proportions. Model 3, the political cycle model. This model is less about math and more about human nature. 2026 is the year after a major presidential election and a midterm election year. Historically, governments are most likely to make difficult, unpopular fiscal decisions, like significant spending cuts or tax increases, immediately following a major election when the political capital is highest. If no action is taken in 2025, the problem will be punted to 2026, where the political pressure of the midterms makes any serious reform virtually impossible. The political window for a soft landing is closing rapidly, and 2026 is the year the market will realize that the political will to fix the problem is gone. The market's patience is not infinite. If Congress fails to address the structural deficit in 2025, the midterm election year of 2026 will become a crucible. The absence of a credible fiscal plan will be interpreted by the bond market as a green light for continued fiscal profligacy, leading to a sharp repricing of U.S. sovereign risk. This is the point where the political model intersects with the mechanical and arithmetic models, creating a unified, undeniable signal. The crisis is here. These three models, the mechanical, the arithmetic, and the political, all point to the same conclusion. 2026 is the year the debt crisis moves from a theoretical long-term problem to an immediate market-moving reality. The crisis is not just a result of past spending. It's being accelerated by current forces. The Federal Reserve's role, the Fed's aggressive rate hikes, while necessary to fight inflation, have inadvertently weaponized the national debt. Every rate hike translates directly into billions of dollars in higher interest payments for the Treasury. The Fed is caught between a rock and a hard place. Fight inflation and bankrupt the government, or lower rates and unleash hyperinflation. Their policy decisions in 2025 and 2026 will be the most consequential in decades. Government spending. The spending continues unabated. The U.S. deficit is not shrinking, it's widening. The political system seems incapable of making the necessary cuts. This is the core of the problem. As long as the government spends more than it takes in, the debt mountain grows, and the 2026 deadline looms larger. The AI factor, You might think AI is irrelevant, but it's a massive accelerant. AI-related investment requires further financing, and the productivity gains are not yet enough to offset the massive capital expenditure. Furthermore, AI is pressuring existing business models, which could lead to acute labor market pain in areas like customer service and coding. This means lower tax revenues and higher social safety net spending, further straining the budget right as the 2026 debt wall hits. The confluence of these three forces creates a perfect storm. The Fed is making the debt more expensive, the government is adding to the principal, and new technologies are disrupting the economy in ways that could temporarily depress tax revenue. So, what does this mean for you, the investor? The 2026 debt wall is not just a government problem, it's a market problem. The bond market. The most immediate impact will be felt in the bond market. As the Treasury floods the market with new debt to refinance the old, bond prices will fall and yields will rise. This is a direct hit to anyone holding long-term Treasury bonds. The risk-free rate is no longer risk-free in terms of price volatility. The stock market. Higher interest rates are kryptonite for growth stocks. The cost of capital rises, making future earnings less valuable today. Furthermore, the sheer size of the government's borrowing crowds out private investment. Why would a bank lend to a small business when they can get a guaranteed, high-yield return from the US Treasury? This crowding out effect starves the private sector of capital, leading to slower economic growth. The dollar. The US dollar is expected to stay resilient in 2026, but the ride will be bumpy. The dollar's strength is a function of global demand for safety, and for now there is no viable alternative. However, the fiscal risks are on the rise. If the market perceives that the US is losing control of its finances, the dollar's status as the world's reserve currency could be challenged, leading to a massive inflationary shock. The economic outlook for 2026 is not a simple recession. It's a K-shaped recovery. On the top arm of the K are the companies and individuals who are insulated from the debt crisis, those with low debt, high cash flow, and exposure to AI and other high-growth sectors. They will continue to thrive. On the bottom arm of the K are the highly indebted companies, the regional banks exposed to commercial real estate, and the average consumer struggling with high-interest credit card debt. They will be crushed. The bond vigilantes are the key actors here. They are the investors who will refuse to buy US debt unless the price is right, meaning the yield is high enough to compensate for the risk of default or inflation. Their actions will force the government's hand. They will be the ones who ultimately impose fiscal discipline, not the politicians. The market will do what the politicians won't. The question is, how high will yields have to go before the government cries uncle? Every percentage point increase in the average interest rate on the national debt adds hundreds of billions to the annual interest payment. It's a death spiral. The good news is that you have time to prepare. The market is giving you a warning. Here is your action plan. 1. De-risk your portfolio. Focus on companies with strong balance sheets, low debt, and high free cash flow. Avoid companies that rely heavily on cheap debt to survive. Think quality, not speculation. 2. Embrace real assets. Real estate, commodities, and precious metals are historically strong hedges against inflation and currency debasement, which are the likely outcomes of a debt crisis. 3. Optimize your personal debt. Refinance any high-interest debt now, before the full impact of the 2026 debt wall is felt. Your personal cost of capital is about to go up. 4. Stay informed. The information I've shared today is just the beginning. The situation is fluid, and the political response will be critical. The year 2026 is not just a number in a spreadsheet. It is the culmination of decades of fiscal irresponsibility. It is the year the music stops. But for those who are prepared, it is also an opportunity to protect your wealth and even profit from the inevitable market dislocation. Don't let this information be the last time you hear about it. Share this video with anyone you know who needs to understand the gravity of the 2026 debt wall. And remember to subscribe to Mac Invests for continuous actionable financial intelligence. The time to act is now.